Hey Shane, how's it going?
It's going, man. Another day. How are you?
I'm doing well. Another day. I think like most, a little shocked by the move we saw yesterday, but I guess after the last big move we had like that off that CPI print, I shouldn't be too surprised on it. But you and I'll talk about this, but did
Oh,
that
I
really
think you
change a
should
whole
be
lot?
very surprised indeed. I think you should be very surprised. I'm surprised. Maybe I shouldn't be, but what a joke. We'll get into it. I'm looking forward to it.
Sounds good. Well, let's start off. We got a nice quote from Elon Musk here. So if you want to talk to that one.
I mean, this is just a picture of what the entire market is looking for. The trend is the Fed needs to cut interest rates immediately. Now, the richest man in the world probably doesn't really care what a carton of eggs costs or a gallon of milk or even a gallon of gas. I mean, this doesn't bother this guy. Cutting rates is going to send inflation higher once more, and this guy is calling for it and getting other people to call for it, thinking it's only gonna help people who have stocks. And the vast majority of this country doesn't own a single stock. People are dipping into their retirement savings in order to pay for the eggs and milk that they need and bread and whatever else, because food inflation is still out of control. Core inflation still out of control, 3 times the rate the Fed's looking for. And this guy is is calling for the Fed to cut interest rates immediately. Like, I don't think that's a good idea. There is a recession coming. That's totally true. It's probably going to be a severe one. And cutting rates just isn't the answer. I don't think that's going to work. You're
Yeah.
going to end up with monopoly money in your bank account. I don't know. People. I mean, we're in a hard spot. I've been talking about this in my market commentaries for I don't know, a year or more now, and there's no easy way out of this. So it's just nonsense that people are calling for this pivot and they're just begging. They're literally on their knees begging for the Fed to pivot to cutting interest rates as if they want higher inflation. I mean, higher inflation is going to send the price of a Tesla vehicle much higher. So what does Elon care? I mean, is he going to raise the price of a new Tesla faster than the price of eggs? Probably. And he just doesn't, it just doesn't seem to care about the the people at the lowest end of the totem pole whose shoulders he's literally standing on. Probably not paying enough to work in his factories and actively trying to automate everything so he doesn't have to pay anyone. It's just to me, it's just obnoxious to do this kind of stuff. Don't get me wrong, I'm happy about free speech on Twitter. I think that's a great thing. Um, the Babylon Bee's back on Twitter, so that's cool. Makes me happy. So I mean, I can't say I hate the guy, every single thing about him, but this is just a mini picture of like the larger macro environment where Wall Street is literally just begging the Fed to start cutting rates so that we can all make the stock market go up again. But that's not what it's all about. I mean, a lot of people that are just they're struggling. I mean, we had Thanksgiving last week and I had family members that are asking me, like, hey, let's not do Christmas this year because they can't afford to buy presents. Like these are real people who are barely getting by. And I just think it's BS to be calling for the Fed to cut rates and do the very thing that got us into this position to begin with. Cut rates, print money, all it's just so irresponsible.
Yeah.
So I wish Elon would stick to, building cool products and innovating and stay out of macroeconomics because he obviously has no idea what he's talking about. Very smart guy, but I mean, it's just asinine. So
Yeah.
bothers me. And then, of course, we'll get to the next slide or some other slides where we'll show that the Fed is clearly not listening.
Yeah. And I think that's a good one to focus on. We could talk about this one and everything that's happened in the market, but this is the key one. We've talked about it and we'll look at the chart, but yes, we did cross the 200-day moving average on the S&P 500. Does that mean that it's time to get in and we're going to the moon? I think these comments beg to differ. So this is from yesterday. Jerome Powell, who anyone who doesn't know is the chair of the Federal Reserve, and
The most popular man alive right
yeah,
now, or
he was
unpopular, depending, I guess.
he was kind of doing a Q&A, I think at the Brookings Institute.
Yep.
And these are some of the comments. And I'll tell you, as soon as he started, the market rallied and it never looked back. But Is that rational? Did that really change things? Let's kind of dive into these comments and maybe we can figure that out.
I mean, we did this before back in late August. I think it was August 26th when he gave his speech at Jackson Hole, and we had 14 different points. All of them were bearish. This time we've got 16 points, and the speech is a little bit longer this time, so there's 16 points. All of them are bearish, but only one. There's one comment that could be misinterpreted as bullish, and we've been going over Fed comments in the past couple of Elevate chats here, talking about, is it dovish or hawkish? And hawkish is obviously bad for stocks or bearish, so hawks and bears go together, and doves and bulls go together. Lots of animal imagery, but literally 16 different points in a pretty short. It was a 6-minute speech. All of them are bearish. There's nothing here to be bullish about. When the market finally begins to realize it, I believe it will come down. I'll be very surprised if these gains hold. I'm not surprised, I guess, that we saw a quick ramp up to the downtrend resistance line and the 200-day moving average on the S&P 500. But I mean, just looking at the bold sections of these comments, I won't read the whole page to you. Y'all can pause it and check it out if you want. I'm also going to write about this in my commentary probably this weekend and put that out next week. But, item number one, inflation remains far too high. And you get Elon Musk calling for a pivot to cutting rates. And not just Elon, but a million other people who are just begging to see these stocks that are down 80 and 90% pop a little bit. And you're seeing some of that today. No surprise that the stocks that are down the most go up the most. So things are rallying 20 and 30% to be down 80, 70 or 80% from their highs. So congratulations, you're up 20 or 30% over the past couple of days. That's a good start to the 400 or 500% you need to get back to the highs. But it's nothing to get crazy excited about. Item number two, by any standard, inflation remains much too high. Shocker, you know. Number three, talking about forecasting that inflation has been going to come down for more than a year, and inflation has moved stubbornly sideways. The truth is that the path ahead for inflation remains highly uncertain. The market usually hates uncertainty, right? If the path for inflation is uncertain, then what the Fed is going to do is probably uncertain too. Well, all we really know is that they're probably going to keep hiking. And we knew that going into this speech. So really nothing changed yesterday. Nothing at all changed.
Yeah, and I think one that stood out to me was the highlighted attention on decreasing rate hikes. We've been talking about this for a long time now. I don't think anyone really anticipated a 75 basis point hike going into December.
Nobody.
So I don't
Nobody
know
was
why that was
predicting that.
news.
Yeah, it's not. It's just obnoxious. Yesterday was also the last day of the month, so you get some rebalancing, you get some people chasing, you get just a lot of short covering though. That's, people were positioned maybe for a quick drop as we were getting close to the 200-day moving average, and they were on the wrong side. They end up covering and pushing the market higher all day. So I mean, you should have been looking for shorts into the close yesterday if you're a trader. Item number four, we need to raise interest rates to a level that is sufficiently restrictive. Listen, read into that. That means they're not at a sufficiently restrictive level yet. So what does that imply? More rate hikes. Item number five, rates will need to be somewhat higher than thought at the time of the September meeting. So the last meeting they had prior to the November meeting, like they're now coming out and saying the terminal rate needs to be higher, which we've highlighted the past couple of meetings. There's a bunch of Fed governors talking about that it needed to be higher. Demand growth is slowed. We expect this growth will need to remain at a slower pace for a sustained period, so not just for a month or two. We have not seen clear progress on slowing inflation, item number 7. Now that's as bearish as it gets. Like, we've raised rates all this way and we haven't even seen clear progress on slowing inflation. And the market's begging to pivot to cutting rates. It's not going to happen. It sounds like Powell is committed to bringing inflation down.
Yeah.
Number 8, services inflation continued to rise. This is likely to continue well into next year. Bearish.
Yep. And then Shane, I've been staring at this one on number 9, but nominal wages have been growing at a pace well above what would be consistent with 2% inflation over time. That's one when I hear kind of the retail investor person out there is that, hey, we can solve this problem if we just increase our wages because then we can
Yeah.
afford groceries. The problem is it's circular. That leads
Yep.
right back into inflation and it just keeps going higher and higher. So, yeah, interesting one I wanted to hit on there.
Yeah, wage growth is one of the biggest drivers. I mean, the more the employers got to pay you, the more they're going to raise prices. It's just that's how economics works. That's why the Fed should stay the heck out of it. They should never have cut rates. They never should have raised rates. They never should print money to buy bonds. They should just stay out of it and let the business cycle do what the business cycle does. Yes, there are recessions, there are contractions. That's just part of a healthy business cycle. You can't try and stop them. Um, Number 10 is interesting. I didn't put anything in bold, but just the labor force participation is that like all-time lows, and it's not going to change. The excess retirements account for more than 2 million of the 3.5 million shortfall of the labor force because people are just retiring early. They goosed the market. They locked down the economy. They scared the heck out of everybody who especially is over age 65, which is the majority of the COVID deaths. So those people got a nice windfall from the stock market going up. They were scared out of going to work, and they're not going back because they don't need to. So labor force participation is really an ugly situation. So the reason the unemployment rate looks so low is because the participation rate is so low. If the participation rate was higher, unemployment would also look worse. So it's those things are, I guess, circular as well. Moderation of labor demand growth will be required to restore balance. So they got to continue slowing down labor demand, which means raising interest rates. Wage growth well above levels consistent with 2% inflation. So that he hit that twice. Number 9 and number 12 hit it twice. Number 13 is a kind of a long one, but despite some promising developments, we have a long way to go in restoring price stability. So more rate hikes are coming. I know that we're just hammering this, but it's like this guy in 6 minutes said all this stuff and the market went up. They weren't
Yeah,
paying attention. It was algos, right? Just looking for the slowdown and the pace of rate increases. And as this 16 points worth of reality sinks in over the next couple of weeks, and then when they actually raise rates again by 50 basis points on I think the 14th of December is the next meeting. Look out, because the market's rallied 17% off the lows a month ago, and there's a nice big long way to fall. All right, so 14, 15, and 16. 14, strongly committed to restoring price stability. So they're strongly committed. They don't care about the stock market. Ongoing rate increases will be appropriate. I'm going to go to 16. The timing of that moderation is far less significant, right? So it doesn't matter when they start slowing. That's not the most important thing. What's important is that they're going to hold policy at a restrictive level for some time once they get there. They're not even quite there yet, as we found out in one of the earlier points. History strongly cautions against prematurely loosening policy. We will stay the course until the job is done. And what he's talking about there is that back in the 70s, they prematurely stopped hiking rates. And instead of having one major recession in the 70s, they had like 4 of them in the course of 10 years. He does not want to have that happen. He doesn't want to have to go back to hiking rates aggressively again because they didn't do the job right the first time.
right.
And so going back to point 15, this is the one that's getting misinterpreted by the market as dovish and bullish for stocks, is that he said it makes sense to moderate the pace of our rate increases as we approach the level of restraint that would be sufficient to bring down inflation. So again, if you read between the lines on that statement, what are they moderating the pace of? Rate
Inflation or
hikes.
rate
No, the
hikes.
rate hikes. They're moderating the pace of rate hikes, which means they're hiking rates. And if they're just approaching the level, let me ask, if you're approaching a red light, are you at the red light yet?
Not
No,
until you
you're not.
stop.
That's right. You're not there until you get there. So as we approach the level of restraint, which means the level of restraint has not been achieved yet. So they've got more work to do. They're going to keep hiking rates. As they hike rates, asset prices are going to come down. Hiring's going to come down. Yes, inflation's going to come down, and that'll be good, but it's still at 7%, man. 7%. It's supposed to be 2. They're not even close. So anyway, for the market to rally on this, it's just nonsense, and should be looking for the opportunity to trim profits off of anything that you're a little over allocated to after the past several week rally. Maybe looking for shorts if you're into actively trading and shorting the market. Um, but this is a time not to get excited, not to get emotional. You follow your process, you stay calm, and you act accordingly. But don't chase, don't get FOMO. None of that. That's not going to work.
No,
Read the statement from the Fed. This is the most important thing that's going on. They're going to keep hiking. Market's going to drop.
you bet. So, here's kind of a next one I wanted to hit on. And I've brought this up before, but if we look at the S&P 500, you go across the top here. So you got your 5-day moving average, 20, 50, 100. The longer the moving average, the more significant it is. And when you talk about chasing the market, if I do want to buy something here, what I want to do is I don't want to go down here to real estate and go to that because 35% are under the 200-day, or I guess it'd be 26% there. You know, yeah, it's a nice bargain bin, but I want to come here to the ones that have been persistently strong. Energy, maybe look at some names there, industrials. But, when it comes to chasing a market, you don't want to go for the ones that are just so beaten down because they might not come back. But look underneath the hood on some of these sectors that have been persistently good, throughout this. The whole year, energy's been looking great. Shane, do you have any thoughts on that?
No, I'm just surprised at how many are actually above the 200-day moving average at this point. This is it's a good sign. I mean, if for a long-term uptrend to begin to develop, but my guess is that this is just a bit of the result of a bear market rally. I mean, when the market does not go up by 4% in a day during bull markets. Doesn't happen. Happens all the time in bear markets.
Mm-hmm.
I wrote about this, I think, in my last commentary. It's like 12 times it happened during the 2008 market, bear market, 2008, 2009, and 0 times did the market go up 4% in a day during the 2021 bull market run. It doesn't happen during bull markets.
Yeah.
So when you see major up days that take things, up above these moving averages, it's usually just an opportunity to sell as they drop below. So I don't know how long we'll stay here. I would expect that a lot of these will be turning back to the red side eventually. Um, but I mean, for right now, for the past 4 weeks, the trend is definitely up, and we've gone over it many times in the Elevate chat. That's a signature behavior during bear markets. You can have big rallies, but they generally roll over and make a fresh low.
Yep. And time frame is always important. I trade a little more actively, so I'm looking over here. 5 and 20 averages, I'm fine. If I'm above them, I'm long. If I'm below them, I'm short. If you're a long-term investor, that's where you're looking over here, longer term moving averages, and you want the strongest sectors. So relative strength, and that's always where, we could be in a bear market and there still are going to be stocks or sectors that do well. So this is a good way to kind of sort out which ones are doing well. And now
Yep.
turning to the SPY. So this is the line in the sand if there ever was one. Not only do we have our downtrend resistance line, but yes, we broke the 200-day moving average. We closed above it. So Shane, what are you looking for? If we just push all fundamentals aside, knew nothing of fundamentals, what would you kind of look for here that would tell you, okay, maybe it does want to go higher? Or
That's a good question. I mean, any holding above that purple line, or really even just holding above the 200-day moving average for a day or two, would give me some confidence that there might be more upside to go. But I think we're limited. That 415 level kind of stands out to me as a spot where things might turn around and come back. I mean, if you have the patience to wait for a rally up to like 415 and then a pullback to back test that trend line or the 200-day moving average, if that were to hold, then you could say arguably it's time to put some longs on there. I don't like that momentum has been positive since the middle of October, basically. So MACD has been that's a pretty long run. It just reminds me of the one that went from middle of June to the middle of August, right? That's a pretty long run of positive momentum. Market was up 18, almost 19% from the middle of June to the middle of August, only to fail and go down and make fresh lows after that. So this isn't, I mean, nobody should be worried about this. Nobody should be excited and, going crazy buying stocks, because we just had this happen and it resolved with a new lower low for the bear market. So, I mean, all else set aside and just looking at technicals, um, anything that holds above the 200-day moving average, I'd definitely consider buying. But if we broke back below the 200-day moving average with any type of volume or velocity, that would be my stop. So I mean, if you really, if you forget about the entire Federal Reserve goals and everything we talked about, to begin this call, and you wanna say, yeah, forget about that. The market doesn't care. It's just going to go up anyway. Well, then go put 100% of your money into a 3 times long S&P 500 fund, right? The UPRO, or buy a bunch of SPY calls, whatever it is that you want to do, and put your stop at a close below the 200-day moving average. And if you're right, you'll make a boatload of money. If you're wrong, you'll lose a little bit of money. And that's how I would trade that if I wanted to go long. For me personally, I'm waiting for that break back below the 200-day moving average to load a bunch of shorts.
Yeah.
So,
And I think, we're kind of looking the same thing, but what I want to see is not only we have a call it a break above this, but I want to see it back test. So I want to see a few days of selling and I want to see it hold this level and start to curl up. That would tell me that, okay, this has something to it. And then looks like you marked this level here, but 402.3, which,
yep.
it's never an exact number, but that's the kind of the high of this consolidation we had leading up to this. We
Hmm.
go back below that, I'm going to load the boat short. But right now, this is just a wait and see. And we have non-farm payrolls tomorrow. So that could be the one that, pushes it right back down into this range, or it could go up, but we've already moved up so much yesterday. I would
Yeah,
be
there's no
surprised to
follow
see
through
it.
yet today. There's no follow through in international markets overnight. There was no follow through in the futures overnight. To me, I think that's a sign that all the people who wanted to buy, they bought yesterday. They were buying all the way into the close. I don't know why. That just doesn't make any sense. I guess because it was the end of the month and they wanted to show their clients that, yeah, we were buying stocks in November. I don't know. We call that window dressing in this business, and it's a thing, man. People, regardless of what the performance is, they just want the month end statement to go out showing that, yeah, we long the S&P 500 and it was up 5% on the last day of the month. Woohoo, and people tend not to dig into it too much. They just say, "Oh, cool, we're long the S&P 500. That's good," and go on about their business. But yeah, I think a lot about. I mean, there was big. I don't have the volume on this chart actually, but there was a lot of volume yesterday. It
Mhm.
was pretty big. I saw the biggest market on close imbalance I've ever seen in my career. It got up to 13 billion to buy,
Yeah, it's a big
which
number.
is more than we need to unpack in this call. But there was a lot of money going into the market at the close yesterday, and you have to believe that some of the people who were going to buy today and tomorrow and the next day and the next day and the next day, all those buyers got pulled forward into buying on yesterday into the close, and so now all that money's in. Once everybody who wants to buy has bought, the only people left are sellers, and the market drops. So I won't be surprised to see us fall from here. I'll be surprised to see a sustained rally higher from here. I really will be surprised by that. But again, you never know. But I've been wrong a lot, so I'm not afraid of changing my mentality or even buying stocks against my own personal feelings about it. We've done that, and it's served us well.
Yeah. And when I look at this too, it's it's hard and it's frustrating because I go, well, here's this lower high. Is that really all I'm trying to get from? Is I buy there and try to ride it up to there.
Oh yeah.
So that's where I just say, I don't want to play that game. I don't need to buy the SPY. So I'll go back and I'll look at that sector map and find those sectors that have done well throughout and see if there's a good name in there. So you don't have to, it's not always about the S&P. This is just kind of the barometer. Tells you what the weather's like out there and figure out, what stocks to play off that. But You don't have to do everything based on what the S&P does.
That's
So,
right.
and then the NASDAQ here. So this one, hey, it had a nice rally too, but it still looks weak. We're still under the
Yep.
200-day, and I don't think you're going to see the leaders from the last bull market emerge as the leaders again. You're going to have some new names come in.
Not with rates going up, dude. As long
So,
as rates are going up, the Nasdaq should lag. I mean, it just should.
and oh, and I
Nothing you
mean,
can do about it.
yeah, the point that I was getting to is it might not be tech. It could be
Yeah,
industrials.
it
Who
should be.
knows? But I'm willing to bet you it's not going to be Meta or Facebook, Netflix, Microsoft. They had their shot, and now we might see some new names.
Yep.
So, but anything to add on that one, Shane?
Nope. Just looks weaker. It's showing relative weakness compared to the SPY because it doesn't have any oil and gas and it doesn't have any banks. Which I don't know why you'd really want to be long banks with the yield curve being as inverted as it is, but that's a much longer conversation. We're trying to keep this one short because we're busy today.
We are. So why don't we go ahead and get right into oil? And Shane, we both talked about this
Nailed it.
level. You called out first. Man,
Nailed it, man.
what a long on oil. Could have got in $74. Today it's at 82.
Yeah, I think we're looking for a break above the 50-day moving average, momentum shift to positive, and maybe a breakout above that 93.50 level before you get too carried away. But I'm not surprised that oil dropped back to the 76 level. I'm not surprised that it held up there when it got there. Nothing will surprise me from here with oil because it's traded by the cartels, so you got to be careful. Um, but yeah, I think it's got enough power to get through that 50-day moving average. But until you get over 85, which is kind of right there where the moving average is, I don't think this is worth really looking at on the long side or on the short side, really. Hopefully, with any luck, it'll just kind of go sideways and consolidate between 76 and 93 before making a move, a pronounced move one way or the other. So, yeah, who knows, man? Who knows? But again, as long as it stays above like 60, the oil producers will continue to make money. Depending on wages, right? As wages go higher, they need a higher price of oil in order to be profitable because they got to pay people. They got to pay for insurance and they got to operate a business. So that is a dynamic number. But up here, certainly above 76, the oil producers are making money. I don't have an XLE chart in here today, but the energy sector ETF is a good place to look for energy names. And after a little bit of a pullback, that one could be gearing up for, if crude oil goes up from here, XLE looks primed to go even higher.
It does. So, back to this one. This is the yield curve inversion, and this is the ugliest chart that I think
Oh
we
man.
have.
Yeah, I forgot to remove the moving averages on that again because I was in a hurry. But yeah, it dropped to like minus 77 basis points, which is the lowest level we've seen since 1981, which I have highlighted in yellow over there on the left. Um, and yeah, recession recession is very likely coming now. I mean, it always has been, but to see it just accelerate to the downside like that is just amazing. And the 2-year Treasury didn't really move yesterday on Powell's comments because it wasn't any different. The
Mhm.
10-year moved a bit, 10-year yield dropped a bit, but the 2-year yield didn't really move much. So um, yeah, this is not a good situation for the economy at all.
No. And then Shane, you brought this chart up. This is just showing, central bank balance sheet tightening. Maybe you can talk to this a little more, but this is the big takeaway I get. Despite what's going on in the market, if you have a lot of liquidity, you can see a market go higher. Now, if you don't have liquidity, it can be a little different. So, I don't know, Shane, if you want to talk to this a little more.
Yeah, I just think it's interesting. I mean, there's not a lot of time, like the chart on the left, and this comes from Hedgeye, who I
Oh,
think are doing really great research lately. So check those guys out if you're interested. But the Fed is shrinking its balance sheet right now, which means they're taking money out of the market. So M2 is just a measure of how much money is in circulation. And after it hit an all-time high, it is now dropping at its fastest rate pretty much on record. I mean, this goes all the way back to maybe 1970 was a little bit worse. And this is the SAAR is the seasonally adjusted annual rate of change. So this is a percentage change year over year in the M2 supply. So there's still a ton of money out there because the Fed printed trillions, and bought bonds with it and all that. But on a year over year rate of change, it just continues to fall. And as they let their bonds mature and reduce the size of the balance sheet, it has the effect of taking money out of circulation. So even if they stopped raising rates tomorrow, they would still be enacting a restrictive monetary policy by reducing the size of their balance sheet. So effectively taking money out of circulation, which brings down inflation, which is great, but it also brings down asset prices. And that's what they want to do. They want to bring down home prices. They want to bring down stock prices. And they won't tell you that explicitly. They won't tell you that they want to cause a recession, but ultimately that's kind of what they're doing. And so I just thought this was a bit of an outlier. I mean, you know, I don't think it directly relates to any specific thing, but it's just when we see extremes like this, I think it's interesting to highlight them and kind of just say, wow, normally the number of dollars in circulation are expanding, right, and causing inflation. Right now, they are not, and that is an abnormal thing, and it does not put kind of wind in the sails of the stock market. So you get big rallies during bear markets, like we talked about, and I think you get big bear markets when things like this are going on in the background. So,
Yep.
so yeah, M2 declines too. I guess it is an all-time low. I guess that is lower than the spike down there in February of 70, it looks like. So yeah, that's I don't know. It's not bullish, I can tell you that much.
Not at all.
I'm happy about it. Don't get me wrong. I think a stable dollar and not printing money just so people can buy stocks with it. I think it's a good idea. So I'm all for it. It's just painful.
Yep. And this is part of what happens when you have a lot of money in circulation, it looks like, is large credit card balances. You can take all that money and go buy stuff. But more importantly, and Shane, you can talk to this. If we have credit card balances increasing, what is that telling us?
People don't have any money.
Yeah.
That's what they don't have any money. They don't have enough money to afford the things that they need, so they're running it up on credit cards. So net new customer consumer credit accounts opened on the left is like an all-time high in quarter three. Why are people opening new credit cards right now? How are they getting approved for them is what blows my mind. Like, wow, And then consumer credit balances year over year percent just grew by the biggest percent since 2000, since ever on this chart, going back to 2004. I don't know if it's an all-time high or not, but so new accounts and overall balance are like extremely high. How is that representative of a strong consumer? It's not.
Hmm.
The consumer's dying. I mean, they're dying on the operating table, and nobody wants to admit it. But this data shows, and I think it's terrifying of what could happen as some of those maybe start to default. And we've looked at the 30-day delinquency rates in the past couple of calls; those are all ticking up. So not only is there more accounts with higher balances, but people are not paying them back at an increasing rate. So again, just not bullish.
No, not good at all. And
Oh, and
one
as
thing,
rates go up, the rate on your credit card generally goes up, and that means your interest costs go up. So the more interest you have to pay every month in order to not default on your credit card means you have less money left over to go Christmas shopping or buy groceries. So
mhm,
it's just a vicious cycle. Credit is not is I don't know. It's not a good solution when you don't have any money. The best solution is to not spend any, not borrow more.
right. And something good to note here on this year over year, this is comparing it to the same season last year. So factoring in, holidays, all that, what it's showing is that, apples to apples, there are more balances increasing. And yeah, it's not good. It's unfortunately it means there's no reserve available to go buy what's needed. And instead they're putting on a credit card that they might not ever plan on paying.
Or maybe they do plan on paying it, but maybe they'll never get there.
Yeah. And then here's one. So we always talk, or, I guess the general market talks about smart money and dumb money. Dumb money being the retail investor. Smart money is your hedge funds and institutional money managers. So Shane, what do you see in here?
You know what? In this case, I think smart money is actually like institutional hedgers. Not, I think dumb money in this case actually is hedge funds, the speculative money.
Okay.
The smart money would, this would be like the dumb money would be like a hedge fund that's focused on trading oil, and the smart money would be ExxonMobil, who's actually hedging, their own production of oil. They have a better understanding of the market than say a speculator might. But neither here nor there. Just who cares what the red and blue lines even are at the bottom? But just look at what happens when the red line goes above the blue line or intersects with the blue line. Sometimes it stays, sometimes the red line stays above the blue line, for an extended period of time, like back in January 2022 or at the middle of August of 2022. Other times it just kind of it fades quickly, like in April. Right now, we're in a situation where the red line's been hanging above the blue line for a while. Um, but just look at where the arrow goes. The black line up top is the S&P 500, and those times where the red line hangs out above the blue line consistently during 2022 have coincided with market peaks.
Yeah.
Um, so it will not surprise me in the least to find out that the same thing ends up being true right now, and we are at a relative peak in this bounce of the market. Um, we'll see what happens, obviously, but this to me indicates that you want to be looking for another drop in the S&P 500.
Yep. And then, excuse me, Shane, with that, we'll end it. Our Babylon B articles as usual. And I guess we do have one more after this, just on the market quick take, but
No, we don't need to go to
um,
that one. I thought
okay,
we'd just skip it.
sounds good. Well, here we have huge Black Friday sale. So thankful anyone that's went out this year bought stuff at last year's prices with these discounts. So
Such a big discount. You get to pay
yeah,
the same price as last year. Congratulations. Or maybe, well, president, I guess he's been president for like 2 years, so maybe the sale got you down to 2 years ago prices.
yeah,
Woohoo.
I think
Very
that'd be a little
nice.
more accurate. So
Yeah. Anyway,
awesome.
cool. Kyle, thanks, man. Sorry to rush through everything, but today's a busier day than normal. I'm not getting my standard relaxing December to start off with. And by the way, as we got on the call, it came out that GDP now model estimate for GDP growth in the fourth quarter is now 2.8%, down from an expected 4.3% last week. So the projected GDP for quarter four is falling precipitously as Black Friday sales numbers come in. Pretty disappointing. So there are always winners and losers every year during the holiday season. But again, the anecdotal evidence I'm seeing is that people are trying to spend less than what they're spending. They're doing it on credit cards, and they're probably not feeling terribly optimistic about the economy or having any type of good sentiment. So it's a stressful time of year, and I pray that all of you get to spend some time with family and don't find yourself in massive amounts of debt trying to get people presents where they don't even need the stuff. So take care of your balance sheet, save your pennies because a recession is probably on the way, and if not, you'd rather buy stocks than apparel. I promise.
You bet. So, well, Shane, thanks again for your time, and we'll see you again next week.
All right, man. Thanks, Kyle. See you, bud.
And bye.